Welcome back to discuss investment banking. Today we'll be discussing module 4, which is do's and don'ts in investment banking. Investment banking operates at the core of the financial systems, where large volumes of capital are raised, allocated, and managed across borders. Because of the scale, complexity, and sensitivity of these transactions, ethical conduct, regulatory compliance, and professional integrity are not optional. They are fundamental requirements for sustainable financial practice. By way of module objectives, by the end of this module, students should be able to explain the importance of ethical conduct in investment banking, identify core do's and don'ts in financial practice, understand compliance framework and regulatory systems, explain fiduciary responsibility and transparency, analyze insider trading and market manipulation, evaluate conflict of interest and its management, understand reputational and systemic consequences of misconduct. By way of introduction, investment banking involves managing other people's money, advising on high value transactions, and influencing financial markets. This creates a strong expectation that professionals act responsibly, transparently, and in the best interest of their clients. Failure in professional conduct can lead to financial losses, legal penalties, reputational damage, and systemic risk to the global economy. This makes ethics and compliance central pillars of investment banking practices. Historical standards involving insider trading, market manipulation, and conflict of interest have resulted in stricter regulations and increased emphasis on ethical standards and compliance systems. Let's look at the concept of do's and don'ts. The do's and don'ts in investment banking represent a structured framework for the acceptable and the unacceptable behavior when it comes to investment banking. These principles are reinforced by regulatory laws, institutional policies, and professional codes of conduct to ensure fairness, transparency, and efficiency in financial markets. Objectives of ethical standards. Ethical standards in investment banking aim to protect investors and clients from unfair practices, maintain market integrity and stability, preserve institutional reputation and credibility. These objectives ensure that financial systems function efficiently and sustainably. Now, professional conduct. Professional conduct goes beyond technical competence. It involves integrity, accountability, and ethical judgment in all financial activities. Investment bankers are entrusted with sensitive information, strategic responsibility, and high value decisions, meaning even minor misconduct can have significant consequences. Impact of poor conduct. Poor professional conduct can lead to financial losses for clients, legal liabilities and penalties, damage to institutional reputation, loss of market confidence. Now, let's go to the do's now. The core do's in investment banking. The core ethical practices in investment banking include 1. Acting in the best interest of clients, maintaining confidentiality, conducting due diligence, ensuring transparency, complying with regulations, demonstrating integrity and accountability. All these are do's. Now let's look at it in bits. We're starting with the first one, acting in the best interest. Investment bankers must prioritize client objectives, provide unbiased advice, and avoid actions that could harm clients. These principles reflect fiduciary responsibility and is essential for building long-term trust and credibility in financial relationships. Now, the next, confidentiality. Confidential information is a critical asset in investment banking. Professionals must protect sensitive client data and ensure that non-public information is not disclosed or misused. Failure to maintain confidentiality can result in insider trading violations and legal consequences. Due diligence involves thorough investigation and analysis before making financial decisions. This includes verifying financial data, assessing risk, and evaluating transaction feasibility. It ensures informed decision making and protects both clients and institutions from unnecessary risk. What about transparency? Transparency requires clear and accurate communication of all relevant information, including risk, pricing, and financial conditions. It reduces information asymmetry, it builds trust, and it supports fair decision making in financial transactions. Regulatory compliance. Investment banks must comply strictly to financial laws, regulatory standards, and internal policies. Compliance ensures legal protections, promotes market stability, and enhances investor confidence in various financial systems. Integrity and accountability. Integrity involves acting honestly and ethically in the absence of supervision, while accountability requires taking responsibility for decisions and actions. These principles form the foundation of trust in investment banking relationships. Now, we have looked at the do's in investment banking. Let's look at the don'ts. The prohibited practices include misuse of confidential information, insider trading, market manipulation, misleading clients, ignoring regulatory requirements, prioritizing personal gain over client trust. We'll look at it in detail. Insider trading. Insider trading occurs when individuals trade securities based on material non-public information. This practice gives unfair advantage, distorts market fairness, and is strictly prohibited due to its negative impact on investor confidence and market integrity. For the next, market manipulation. This involves artificially influencing prices through deceptive practices such as false information, wash trading, or spoofing. These actions disrupt the natural price discovery and undermine financial market stability. Now, misleading clients is another don't. Providing false or incomplete information to clients is unethical and illegal. It includes overstating returns, hiding risk, or presenting biased analysis. Such behavior damages trust and leads to severe legal and reputational consequences. Ethical responsibilities in investment banking extend beyond legal compliance and include principles such as honesty, fairness, integrity, and responsibility. This principle guides decision making in complex financial environments. Let's look at transparency in practice. This is a core do. Transparency requires disclosure of risk, clarity in pricing, and accurate reporting, like we said. It builds trust, reduces dispute, and ensures that clients make informed decisions. What about fiduciary responsibility? This requires the investment bankers to act in the best interest of clients, avoid conflict of interest, and provide objective advice. It includes duty of loyalty, duty of care, duty of good faith in all financial interactions. What about ethical decision making? Investment bankers must evaluate decisions both based on both legal and ethical considerations. This includes assessing long-term consequences, maintaining fairness, and avoiding actions that compromise professional integrity. What about the compliance framework? Compliance involves adherence to laws, regulations, and internal policies. It protects investors, maintains orderly markets, and reduces systemic financial risk in global financial systems. Let's take a quick look at some of the regulatory bodies. Global regulators such as SEC, Security Exchange Commission, FCA, and ESMA for EU, and local bodies like Central Bank of Nigeria and SEC in Nigeria enforce rules governing financial markets. They ensure transparency, investors' protection, and market stability. Let's look at internal compliance systems. Investment banks establish compliance departments, monitoring tools, risk systems, and audits to ensure adherence to regulations and to prevent misconduct. Let's look quickly at reputational risk. The reputation of an investment bank is a critical asset. Ethical failures can lead to a loss of client, regulatory scrutiny, and financial damage. Maintaining ethical standards protect institutional credibility and long-term success. Conflict of interest. Conflict of interest arise when competing interests affect objective decision making. These may occur between client, institutions, employees, or departments and must be carefully managed to maintain fairness and trust. Types of conflicts. We have client versus client conflicts. We have client versus institution conflicts. We have employee versus client conflicts. We have departmental conflict within the institution. Institution here being referred to as the investment bank. Now, how do we manage conflicts? We have disclosure to clients, information barriers, segregation of duties, compliance monitoring, and employee training and awareness. What are the consequences of violations? When you violate an ethical principle, it can result in legal penalties and imprisonment, loss of employment and licenses, trading license, reputational damage, loss of investor confidence, and systemic financial instability. By way of conclusion, investment banking requires not only technical expertise, but also ethical standards and compliance and professional discipline. Adherence to do's and don'ts ensures trust, stability, and long-term sustainability in global financial markets. But then in this module, there's a two-part assessment to give you a better understanding of investment banking. I'll see you in module 5.